What's up everyone, it's Scotty with Money Investing. In this video, we are going to be looking at some seasonal trends to really break down the ideology behind the markets and the seasonal trends of selling in May and actually going away. So I've got a lot of data points, a lot of facts, and lots of charts to break down in this video. As always, if you enjoy it, find it helpful, make sure that you drop a like. Don't forget to subscribe to the channel. If you're just joining us for the first time, the link to our Discord and Patreon is going to be down below if you're interested in joining us. Of course, getting access to all the buy and sell alerts, options alerts, trade ideas, day trading ideas, everything's going to be included, as well as the member benefits and private videos and private live streams as well, as we are doing private live streams for members only Monday, Wednesday, and Friday. So link's going to be down below with that 16% annual discount. So when we talk about sell in May and go away, it's not so much about the month of May itself, but what happens in subsequent months all the way through October. So there's been this long-held ideology where you sell in May and then you buy back in October. That's really where the seasonality comes into play, because if you take a look at the seasonal trends of markets in the S&P 500, summer months are usually the months where people are traveling, hedge funds, institutional, big money managers, the volumes pretty much drop. And as a result, there's not a lot of activity in the markets, and as a result, we do start to underperform. In other words, the S&P 500 starts to pull back or trade sideways. We see a lot of consolidation. So those are usually the months that don't necessarily perform super well, as opposed to Q4 when there is holiday season, when there is a lot of spending, when there's a lot of earnings coming in very strong, and the markets absolutely rockets higher. So this right here are going to be some of the seasonal trends. And as you can see that in the month of May, it's not as terrible as some of the subsequent months that follow after May. So May, we've seen since 1950, so last 72 years, 29 years have been down years and 44 have been up years. So it's actually a pretty bullish month, the month of May itself, with a 0.17% average return. But if you take a look at what happens in the subsequent months, right? So June, we've had 38 up years and 35 down years, and the average return is negative 0.04%. So it's almost 50-50. In other words, 50% of the months of June in the last 72 years have been higher versus 50% have been lower. This right here is going to be July. Again, another year which is on a net basis pretty bullish. So 43 up years and 30 down years with an average return of just over 1%, probably one of the best summer months. And this right here is going to be August with 40 up years and 33 down years. And even though the bullish years have been higher, or in other words, most of the August months, the markets are higher, we still have an average return, which is negative 0.18%. And of course, we come to the worst month of the year, which is September, where the average return is negative 0.8% with 41 down years and only 32 up years. So if you do the math, 41 divided by 72, we're looking at 57% of the times September is brutal. In fact, even last year, the last couple of years, we've seen 2022 markets were down almost 9% in September, and in 2021 they were down over 4.89%. So it's really not so much about the month of May itself, but it's really about what it follows up with, which is May, June, July, August, September, those 5-month period where the returns are the least favorable for investors. Now, in the month of May, we also have the Fed meeting, and I'll go over that in just a minute. But this right here is market returns that have been demonstrated strong seasonality, rising sharply from November to April, and then producing modest returns between May and October. So there was a study that was done, and in this research, they pretty much what they did was they sold stocks in May, and they invested in treasuries, long-term treasuries, US treasuries, and then they bought back into stocks, equities in April, right? That's really where the seasonality and the allocation starts to play in. So in this research, they pretty much had a simple strategy where they owned stocks from November to April and then owned treasuries from May to November. And the returns were absolutely staggering. This right here were the actual returns. While the S&P 500 produced a negative 37% return in 2008, the sell in May and buy treasuries portfolio was just down 8.7% in 2008. And that switching strategy was in treasuries during the Lehman bankruptcy and the market swoon in the fall of that year. And the quote, sell in May strategy posted its worst year in the stagflationary environment of the 1974 when it was down 9.1%. But over this 40-year plus period, the results become fairly astounding. The graph below shows the cumulative return of the sell in May and buy treasury portfolio, long treasuries portfolio, and the S&P 500. So really what this does is that it sells in May, buys treasuries up until November or after October, and then switches back over to stocks or equities. And you can see the difference, the stark difference between these two strategies. And it's very much about risk aversion, because if you think about it seasonality wise, May, June, July, August, September, those 5 months as I showed you are the least favorable for equities, or they are the most underperforming months in a given year. And if you are looking into risk aversion, long-term treasuries or US treasuries are a place to really park your cash until, of course, September has proven itself to be a very brutal month, and you can take advantage of those deals in October and start buying into stocks once again. And as a result, you can see the stark difference where the S&P 500 significantly being outperformed by this sell in May and switching strategy. Now, this right here is, again, the Federal Reserve's FOMC meeting interest rate projection. So 89% almost is expected that the Federal Reserve is going to raise rates by another 25 basis points in May, which once again could spark a little bit of some, bearishness in the market, so to speak, and we could see a lot of consolidation sideways or a potential pullback in the markets as well. Of course, a lot of it is riding on earnings and, of course, how interest rates end up doing for the future as well. Now, this right here is another really interesting and nice statistical analysis, which pretty much mentioned that statistically there is some truth to the trade from a historical perspective. The 6-month stretch from May through October has been statistically the worst 6-month stretch for stocks since 1957. However, the S&P 500's performance during these 6 months is far from bad. The index has averaged 1.5% gain overall during that stretch and has traded higher 64% of the times. So I think this study right here that I showed you, this right here has really that outsized loss in 2008 and 2000 and in the 1970s great inflation, because of the fact the market was selling off so aggressively back during the dot-com bubble and the great financial crisis, the housing bubble, and of course the great inflation period of 1970s. Investors were very much risk averse, and as a result, bonds actually ended up performing much better than equities in those time periods, and as a result, the returns are the way that we are seeing at the moment. But this right here is a study that goes over how November through April, the 6-month period of November through April, has the best return of 7% and is 78% higher. So probability of stocks going higher or being, on the rise between November and April is 78.3%, because we've already looked at December being the best month seasonality wise for the stock market. And of course, November, October are right next to it. So Q4 and Q1 of any year really is a very, very bullish time to be in the markets. Now, the second best is October through March, which again, you're buying a little bit before November, right after the sell-off in September, and you're selling in a little bit before April. 6.2% return with a 68% probability that it is going to be green. And December through May is going to be 5.5% with a 72.5% probability that it's going to be higher. Bottom line is that every time there is selling preceding May, there has been much higher returns, as opposed to if you are in that time period between May through October, the returns are a mere 1.5%. And of course, the probability is still for the markets to be higher at over 64%. But again, we've seen months where September has been brutal. It's, really given us those outsized losses, and not to mention that summer months volume is also lower. So we can see underperformance, and treasuries tend to perform much better during that time, considering the research that we also have from over here. So I'll let you make the decision for yourself. This right here is the April's monthly performance, as we went over earlier. So winning percentage, 67% of the times markets are higher in the month of April, going back as far as, I think, 1950s here again. So we're going back 64, 65 years. And losing percentage, 33%. But this month, in April of 23, what we're really seeing is a lot of sideways consolidation. The markets haven't really moved anywhere. In fact, we are very flat on the year so far. And the chart below has been annotated and updated since the report. So we're kind of moving gears here and really talking about liquidity in terms of the Fed's balance sheet and how that's going to play a role going into May, June, July, August, and September. So as we approach the sell May period, the liquidity index is declining and will likely fall further as the Treasury and the government wrestle over the impending debt ceiling. So we also know the Federal Reserve has been contracting its balance sheet. They've been letting go of some Treasury debt US mortgage-backed securities, US treasuries, all those things. And if you kind of combine the liquidity index, which is the Fed's balance sheet, with respect to the S&P 500, they kind of move in a very much correlated to each other. They're very positively correlated to each other. So if one of them goes up, the other one also goes up. And right now we do have liquidity getting sucked out of the system. And as a result, S&P 500 also struggling at the moment. So if this continues, there could be some underperformance from the market with respect to some of the other asset classes as well. Now, furthermore, the more recent release of Philadelphia Federal Reserve Manufacturing Index also showing a sharp plunge in sentiment, suggesting a more pronounced correction than earnings currently represent. Historically, such deep readings of Philly Fed Index were associated with harder, not softer economic recession. So that's another wild card in the economy. If there is any incoming recession in the US, whether it's economic or earnings, that's obviously going to put more pressure, more impact on the S&P 500, on the NASDAQ to continue to maybe trade sideways or, once again, underperform relative to some of the other asset classes, especially when we're going into these summer months here moving forward. Now, the Federal Reserve, again, is set to hike rates, as I showed you guys earlier, 89-90% probably. The Federal Reserve is going to hike rates by another 25 basis points. Now, while the technical indication may be enough warning on their own to reduce risk heading into May, it is worth remembering the Fed is set to hike rates again on the 3rd. With each rate hike, we're getting closer to the Federal Reserve's breaking something economically or financially, and such has repeatedly been the case throughout history. And given the aggressiveness of the rate hiking campaign over the last year, a negative outcome would be unsurprising. Right now, we haven't really seen the actual Fed funds rate kind of parse through the economy because it's still very much of a lag, right? We're still seeing these lagging effects take place. And as interest rates continue to get pushed higher, the terminal rate's going to be a little bit higher. I think we should start to see some of the impacts of these higher interest rates very soon, as many companies have already started to lay people off. They're doing these cost-cutting measures. We're not seeing as many IPOs, of course, and there's a lot of bankruptcies also happening. Delinquency rates are going higher, so there's a lot that's still yet to stem through the economy as part of these higher interest rates and the aggressiveness from the Federal Reserve. So hope you guys enjoyed this video. Let me know your thoughts down in the comment section below, and what do you make of this sell in May and go away strategy. Really, I mean, if you are a long-term investor with, really just not into the seasonality trade or switching different asset allocations here, then of course you can disregard and understand that most of the times markets are still higher, but of course there are other asset classes, other opportunities which might perform better for your money, for your investment, as opposed to S&P 500, which is only up 1.5% in that 5 to 6 month period between May all the way through October. But the best performing time and the time where you absolutely ought to be in the markets, at least in my opinion, and of course the data suggests and backs it, is November through April, where the markets on average are up over 7% in the last 72 years, and the probability for us to be green during that time period is over 70 at almost 80% really. So again, hope you guys enjoyed this video. Let me know your thoughts down in the comment section below. As always, make sure that you drop a like, subscribe, and link to our Discord and Patreon is going to be down below with a 16% annual discount. As always, happy investing, and I'll see you all in the next video.